The third way is buying a business that cash flows immediately, which you can also build equity and has growth upside. For me, buying a business is the most powerful of the three. Welcome to Business Buying for Financial Independence. I'm Tim Delaney, and I help young professionals buy small businesses so they can escape the 9-to-5 and take control of their time, income, and future. If that sounds like you, hit the subscribe button and let's get into it. Welcome back to Business Buying for Fi. I'm your host, Tim, and today I have a solo episode for you where I'm going to tackle the question I get all the time. Is buying a business a good investment? Sounds like a pretty straightforward question, simple yes or no. But the truth is, people come at this question from different angles. Some people are talking about their return on capital, others the risk factor, others their time and effort, and still others the freedom aspect. So in this episode, I'm going to break down from a few different angles. Whether you're considering your first business purchase or just curious about what this path actually looks like. So stick around. Before I jump in further though, I'd really appreciate if you could take a second and hit that subscribe or add button on whatever podcast app you're listening to so that you can be informed when I drop new episodes. Thanks. All right, return on investment. Let's start with the money side of things. When I bought my first business, I paid about $300,000. Almost 90% of that was financed with loans. There are a couple different ways that people calculate their returns. They're typically either using ROI, return on investment, which is the money made divided by the total purchase price of the business, or they might be using a cash on cash metric, which is the total money made divided by the actual cash that was invested into the business. Or some people use IRR, internal rate of return. This is a little bit more of an advanced calculation that takes into account the time value of money and what you could have been making otherwise. This is not typically used in small business acquisitions, but it is a metric that is out there, just so you're aware of it. So even though I used a small amount of my own cash, we still use that total purchase price to calculate the ROI. Now, one variable with small businesses is that some people will incorporate the owner's salary into that return number, into the cash that the owner is making. Purists will say that that's not acceptable because that money would be for a paid employee, not necessarily for the owner, which is fair. But if you're going into the business purchase planning to be the owner, then I think it's fair to include that number in your actual return on investment. So in my particular case, I could calculate return on investment in two different ways. Without my salary, in the first couple of years of owning the business, I had about a 10% ROI, which is okay. It's not much more than the typical stock market returns. So one could argue that that was not a very smart investment. But when I factored in my salary, the ROI jumped to over 30%. So I was able to recoup almost my entire cash outlay in the first year just from the profits alone. Because remember, I financed about 90% of the business. So given this, my cash on cash return was actually a full 100% in the first year and then led to infinite returns going forward since all of my cash was already recouped. Compared to real estate investments, this is a decent return, that 10%, 30%. I also invest in real estate and I've been able to pull out infinite cash on cash returns in some of my investments. And in others, I've been more modest ROIs in the teens. So it is a fair comparison, business to real estate. However, unlike real estate, where appreciation just kind of happens over time with most single family, small multifamily housing units, in a business, the real gem is the forced appreciation, the growth of the business that you put in over time to make the business worth more in the future. And again, yes, you can do this with real estate, but with a business, the opportunity is much higher because you're not only comparing it to the neighbor's house, but you're comparing it to how much cash you could otherwise be making. And if you scale up the amount of cash that the business is making, there's really no ceiling on the price point. Versus real estate, when you're in a certain neighborhood, you're only going to be able to force a certain amount of appreciation before the buyers cap out at what they're willing to pay. Looking at the question of, is a business a good investment from the risk and stability angle, which is what some people are kind of questioning when they ask that question. So with every investment, there is going to be some level of risk. The question really is, what kind of risk are you comfortable with? Buying a business has a lot more upside than stocks and bonds, but it also comes with risk. The big difference is that you control this risk in a business. And for me, I prefer to have control over my investments. With stocks and bonds, I can't change anything about those businesses. I don't get to call up Tim Cook at Apple and say, hey, I think you should hold off on the new iPhone this year. It just wasn't up to standards. Or, hey, you better rush out that new iPad. I need some more liquidity in my bank account soon. So better get that going. That just doesn't happen with publicly traded companies. You have zero control over what happens with those companies. But when I own the company, I can adapt, I can change, I can make decisions in real time. I can pay attention to the macroeconomics, I can pay attention to the economics in my community, and I can make adjustments on the fly as I see fit. The fate of the business is generally in my hands. Sure, there's always going to be external risks that are completely out of anybody's control, but for the most part, it still comes down to my decision at the end of the day of how the business is doing. I think a lot of people also just overestimate the risk of buying a business because they've heard all these statistics about 9 out of 10 businesses fail. Yes, the failure rate of businesses is high, but a lot of those metrics take into account startups, and they take into account like LLCs that are formed by people that are just left to die at some point, or tech startups that try and fail quickly and move on to something else. So when I'm talking about buying a business, you're already established. You already have good financials. You already have a solid customer base. And you can get a transition plan from the seller with strong support and help. So it's a whole different story of the level of risk that you're getting into when you're buying an existing profitable business. Furthermore, you can help mitigate some of this failure risk by doing thorough due diligence, talking to advisors, really doing some research into the business, and then setting up that transition support from the seller. You can also have locked in recurring contracted revenue, which, as strange as this sounds, sometimes the business-to-business businesses are actually a more stable or safe investment because of these long-term contracts that they might have in place, as opposed to something like a restaurant, where the average Joe thinks that they understand because they've been to restaurants and they eat at restaurants, and therefore they think they can run a restaurant, whereas it is a little bit more complicated than just walking in and cooking food. So understanding the risk going in, planning for it, doing due diligence can really reduce a lot of that risk in buying a business. The third angle that people talk about, or I think that people are thinking about when they're asking whether or not a business is a good investment, is the time. For a lot of people, this is really the question they're asking. Is it worth my time and energy? Now that's going to depend a lot on your personal lifestyle. If you're a high-paid executive working 50 hours a week, making a strong 6-figure salary, jumping into a small business just to earn the same or maybe even less in the first couple of years with more risk, more headaches might not make sense to you unless you're planning on building something bigger. Short-term sacrifices for the long-term gains. And if you're going to be buying a business, that's kind of what I advocate for. Don't just buy the business to continue running it the exact same way. Think about how you're going to grow it over time, how you're going to improve it, and how you're going to increase your cash flow. When I bought my business, I planned on working it full time. And that gave me options. I was able to pay myself a paycheck from day one. Was it as much as I had been making in my previous corporate job? No, it wasn't. But I was okay with that because I knew that I would get to a higher level faster through buying my own business and putting in the time and effort and energy building my own business than I would from continuing to continue working corporate jobs. My goal was eventually to step back. Now, it took me about 6 to 8 years to get there, where I slowed down and eventually stepped out of most of the day-to-day of the business, but I got there. And now it continues to produce cash flow without me needing to be there every day. That's the real freedom. Compare that to a job. So if I was working in a corporate job for 6 to 8 years and I got really good at building systems and scaling up my team and getting them to do things really well to the point where I didn't need to be there as much, that everything was handled, could you see the company saying, that's awesome, thanks. You can not show up and we'll just keep paying you for all your hard work that you did? No, of course not. They're just going to find more and more stuff for me to do. They're going to give me more responsibility. Yes, they might pay me more on top of it, but they don't always do that. So think about what you're putting in, that time and effort. Is it worth it to build something that can scale and that can operate and continue generating cash flow over time without you? From my perspective, it's well worth it. If you buy a business and plan to work in it, that's just fine. Don't let people scare you about saying you're just buying a job. Yes, sometimes you are buying a job, but if you have a plan to get out of that job, then it is good. Just make sure that you carve out the time to work on the business, not just in the business. And if you can afford to hire somebody to run the day-to-day from the get-go, great, even better. Just make sure that the cash is there to support that. So the fourth angle that I think people are asking about when they talk about the question of, is a business a good investment, is the financial independence path. So how can buying a business help you achieve financial independence? The way I see it, there's three main paths to FI. You can earn a great salary, invest heavily in stocks through a high savings rate, or you can buy real estate at a discount, build equity and cash flow through that process. Or the third way is buying a business that cash flows immediately, which you can also build equity and has growth upside. For me, buying a business is the most powerful of the three. Here's why. For starters, you can use leverage to buy it, often with as much as 90 or 100% financing. Even if the cash flow is modest at first with that high of leverage, that debt paydown builds equity fast. A lot of business loans are typically in 5 to 10 year range, which means that you're going to be able to pay down that loan very quickly in the relative scheme of things, especially as compared to a real estate loan, where you might be 80 to 75 to 80% leveraged on that investment and barely making any cash flow and still paying that loan for 20, 25, 30 years. Versus the business, the banks kind of demand they see a debt service coverage ratio of at least 1.25%. So you're going to be generating enough cash to cash flow to put some money in your pocket every year while paying down that debt for, let's call it 7 years. And after that 7-year point, all of a sudden that debt goes away and you're going to have even more cash flow coming in. Now, the SBA is evolving. They've changed some of their financing criterias. They are not necessarily allowing seller financing to count as your equity portion anymore, but there still are some great opportunities out there for financing a business acquisition. And when you're thinking about financial independence, it's also important to think about the exit. Whenever you're planning, doing a business plan, there is a section in the business plan that is vital called the exit strategy. Even if you don't want to think about your exit and you think you're going to hold the business forever, that still is an exit strategy and still needs to be documented as to what your plan is. Are you going to hire a manager full-time and step back completely and just collect the cash? That's fine. That's your exit strategy. It needs to be documented and planned for accordingly, because 2, 3, 5 years out from when you want to be retiring, you're going to need to start making sure that you have the right people in the right places to make sure that that happens. There's also sales of your business, whether you just plan to run it for a while and then sell it to somebody else that has the same kind of mindset as you, or can build a business in a certain way so that a private equity company or a larger firm doing roll-ups in your industry might be interested in it, or even a competitor. So there's different ways of thinking and building the business depending on what your plan is for that exit. So make sure that you're thinking about that from the day one in terms of that financial independence piece. So if you're listening right now and you've been on the fence, maybe you've looked at a few listings, downloaded a couple informational packets about different businesses, but you haven't pulled the trigger yet, here's what I'd tell you. Just keep analyzing businesses. The more you look at, the more confident you'll get. The more you run your numbers, the more you talk to brokers, the more conversations you have with sellers, the more you'll start to realize that most sellers aren't any smarter than you. They don't have some secret weapon. You've got a vision, go implement it. And soon you'll start seeing the value that you could add to their business. So when the right one comes along, you'll know and you'll be ready to pull the trigger. Thanks for listening to this solo episode of Business Buying for FI. If this helped shift your thinking or gave you a nudge in the right direction, please do me a favor and hit that subscribe button. Would really appreciate building the audience so that more people can find me. As always, I'd love to hear from you. Please let me know what other questions you have. Look forward to talking to you again soon. Cheers. Thanks for listening to Business Buying for Financial Independence. If you're serious about owning your time and building long-term wealth, make sure to subscribe so you don't miss the next episode.